I'm Jim Yant from Generations Wealth Advisors, the home of the Kairos Formula. It's Thursday, March 19th. We thought it was time to give you an update on the Iran war and what's it meaning to the market. From the very start, I just want to say this isn't meant to be a political comment. We're not trying to take a Republican or a Democratic stand on it. We're just trying to face the facts that although militarily, the US and Israel are completely dominating. We're kind of in a tough spot where we're at right now. And really, we have to be honest, no one knows how this eventually unwinds, but we thought we should give you an update of where we're really at and what it means from a market and a portfolio perspective. So, what are some of the potential off ramps that no one really can figure out how we can leave the current war? Well, number one is what I'll call a walkaway victory. President Trump won't be the first American president who, declared, mission accomplished. In fact, we kind of have a track record when it comes to international military excursions like this, to use some of the words that are being bandied about, that it's militarily we do great, but really the goal tends to be something more than that. A regime change always is one of our goals, but it's very hard to implement. It's hard to implement this time too. I like to make the comparison between taking out like organized crime, a drug lord, versus taking out terrorists either at a regional or at the nation state level. It's just way more difficult. It makes cancer look simple. We know how destructive cancer is. So besides the walkaway victory approach, there's several things that you hope we can accomplish. We don't know if we can, but one would be remove or recover the near weapons grade uranium that's out there. That would be a big win besides what's already occurred militarily. And more pressing right now is we have to reopen the economic side of this, the Straits of Hormuz for free trade. We're starting to see some infrastructure, economic things get blown up on both sides. And the more that happens, the more long-term pain we'll have. But this is the one that's really front and center. As we speak, 20% of the world's oil goes through that little 21-mile gap called the Strait of Hormuz. And if you want a breakdown of really, it's 14 million barrels a day, this is how it's used. 89% of it's going to Asia, with the bulk going to China, then India, South Korea, and Japan. We ourselves take a small amount. Although we are a net exporter of oil, and that's a great position to be, there is a small amount, it's 6%-ish that we do use, so we'll have to make that up from somewhere else. And then the remaining 5% is really from other parts across the globe. So if Asia gets met, we still need to stop the fighting and have other traffic other than oil, namely fertilizers and other products, mineral products, really, because otherwise it's going to be a really bad harvest across the globe, and you'll see food prices already too high get higher. So if we're talking about oil, it's an oil spike. That's what we call it. And although the legend is wrong, this is going back, and you'll see starting back in the 90s, we've had several spikes. The 90s, around 2000, the '08 financial crisis was the biggest one, where we hit about 145-ish dollars a barrel. And those gray bars is they caused recessions all those past times. We've seen several spikes since then. Early 2000s after that, the COVID situations, and now the far right. This is as last Friday, we actually hit over the weekend, we hit like $120, but this is the actual trading times that you're seeing there. We've survived in the past. We'll do it again. Here's an update as of close of market yesterday, where Brent oil did break 110. It hit about 111. And West Texas Intermediate, that's U.S. oil crude, just a hair away, a quarter away from being $100 a barrel. So, that's what's going on price-wise. This is what's going on from the supply side. If you look to the far right, that little downdraft across the globe, and it all depends on whether you're just talking crude, Because if you look on the chart, it says crude and liquid fuels. So there's things other than crude oil that whenever you hear 100+ million barrels a day, they're talking about beyond the crude portion that's being burned every day. It's kind of like somewhere plus or minus 80 million barrels of crude, but everything else is liquid natural gas, condensates, a bunch of other things. But you look to that far right, we've just had a couple of percent drop. That's all that's happened thus far in the supply. The longer that gets tied up, we wanted you to see the potential impact, could approach 20, but probably not because already Iranian, Indian tankers are being let out by Iran, and thus far, America and Israel are not stopping those vessels. So it should be a more contained situation. But the threat of any kind of war situation and oil spikes is inflation. So what we're looking at, the February numbers came out, in fact, just this week. The first three numbers, which is the producer price index, came out. The middle column shows you the monthly change, but on the right, the year-over-year change is big. It's higher than what we'd like to be. It's in the mid-3s to 4% levels on just producer prices, core prices, or service prices. The next two rows were announced last week, and that's the consumer side of inflation as well as the core pieces. And they're still elevated. The target was 2, and we're kind of like mid-2s. Now, remember, this is February data, so it's all pre-war. And in fact, on the consumer side, early in the year, I mean, just before the war, oil was at $65 a barrel, not sitting, somewhere around 100 plus with that 70-80% spike in prices. So, hang on because we will see some inflation spikes out of it. Now, the amazing thing to most analysts, advisors, investors is thus far the markets have been pretty calm about this. On the chart, you see year to date, the red is the S&P 500, the blue is Barclays aggregate bonds, US bonds. And towards the end of January, we hit an all-time high. We only went up about less than 2%, but it was an all-time high. And since the war began in February 28th, we have fallen. You see that slide, but from peak to trough, we're just broke 5%. We didn't even hit 5% till last night. So it's not a correction. It's kind of just maybe a mini correction. And we've been bouncing off the 200-day averages. So we're keeping our eye peeled on this and watched it. But it's really amazing the resiliency of both the markets and the economy thus far with missiles flying everywhere. If that's what's happening on the S&P side, this is what analysts are still seeing. It's almost like the analysts are ignoring or didn't get the memo. There's a war on. That red line is the forward earnings projections of the S&P 500, and that middle blue line is for 2026, and that's where we're at. This was as of last Friday numbers on all this. So, they're saying as they go forward in the year, they still see an upward sloping earnings for the S&P 500 companies, above, because it's a 12-year forward and we're already in March now, above like 325-ish, between 325 to 330 over the next 12-month horizon. And you see, I mean, it's staggering what they're saying. It's hard to believe how optimistic it is for 2027. Many people were more in that 350 to 360 range. They're seeing this thing really accelerating. That's on an annual basis. This is the next 4 quarters. So we're in Q1, the bottom blue line. Always right before the earnings seasons, they come down. So don't let that little downward slope bother you. Usually they're upward sloping. And then right as we get to the real dates, they shave it down to try to really hit the numbers. But Q1, Q2 is higher, Q3 is higher than that, Q4 is higher than that at the moment. That's the outlook. So a lot of resilience is the best way of really describing what's going on. So if you recall, we at the kickoff, we put this slide up. This is what the S&P composite is in midterm election years. And we said, don't try to time the market from this. But when we look at it, we see, well, it should be an up year. But we said there's a lot of chop and a lot of noise that happens. And then really come election time forward, there's usually a run. That's the historical pattern. Doesn't read the paper, doesn't know there's a war. So we're really kind of on a different tack thus far. You'll see first quarter heading into early May, pretty strong things. We haven't had that. We did hit that January high, but it was only 1 to 2% high. Now we're drifting down because of the war. But we haven't seen any of the big chop that you normally see. So as a result of that, when it comes to the portfolio, the whole message that we're trying to get across today is thus far, any changes that we're doing are really within the strategies, meaning that if we see buying opportunities, we've already taken action and we've gotten to enter some things that we've wanted to enter for a long time. And when we saw little price drops, we've jumped in and we'll continue doing that. But thus far, really no active big defensive moves have happened because we're just in the mini correction stage. Because mid-tier election years are typically very volatile, we've talked with several customers about increasing risk. We've really put those on by moving to strategies that are either more aggressive or are more buy and holdish in nature. We've really kind of put that on hold at the moment. We just want clients to know that. We're waiting for an even deeper decline in the markets, at least a correction level, a 10% or more type correction before we make any of those swaps, because there's just too much uncertainty to add more risk at this point. And as I said earlier, we haven't really added more defense either. So bottom line, markets are resilient. We see that we'll have to be making moves going forward. So we will. But right now, it's really within the strategies, not across strategies. So focus on what matters. We know what that is, your life, your loved ones, and we'll keep our eye on the markets. So keep the faith. Have a great day.